that.
Money for everybody.
Right. But they call it support for Canadians.
Yeah.
Right. And this is caused a lot of problems for us and continues to cause a lot of problems for us because there is no such thing as a free lunch.
No.
And Canadians haven't learned that yet, which is shocking to me. It's shocking to me that Canadians haven't learned yet that there is no such thing as a free lunch, that we pay for everything. We
Yeah.
pay for it through inflation. We pay through it through higher taxes. We pay through higher interest rates. We pay for it. The piper gets paid no matter what. And we haven't learned that yet. And so I guess the next logical step for this is, how do people protect themselves against that? Because it's most definitely going to come, and we are not going to just stumble and magically fall out of this economic situation into a feather bed. It's not going to happen like that. Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify. What's going on, man?
Not much. Thanks for having me again.
Thanks for coming back, as always. There is a lot of doom and gloom. We had a conversation on the phone just like for a few minutes.
Yeah.
It was a couple of days ago, and I was like, how are things going? And you were like, ooh, it's rough out there.
It is rough out there. The appraisal situation right now is very peculiar because what's happened in the last few months, as everybody sort of has been, if you've been paying attention to the sales, the trend sort of continued where those people who were most desperate to sell because they just couldn't handle sort of what was in front of them with payments and everything else, right? Especially renewals coming up right now. Like there has been a bit of an influx in inventory, and what that's done to the appraisal situation is, because the ones that sold for the most part were the desperate sales, and the ones that didn't sell are the ones that are still sort of seeing if they can maybe wait for a little better market, sell a little bit higher. What's happened is the only sales you have to use for comparables on appraisal is the distressed sales. So it's driving the value of appraisals down significantly, right? So where the homes that not much has changed since last year, 2023, they were appraising at $1 million. Now they're being pulled down to 900,000 on their valuations because there is no sales that are valuable to the appraiser to use a higher number. They're too old, and the recent sales that they use are all desperate sales. So if all you have to pick from is the ones that are not doing very well and the only ones that are available, I mean, the valuations are coming in all kinds of wonky. And that's creating a big problem for the people who are in those situations. Because if you had, let's say, just traditional mortgage and it came due for renewal, your biggest pain is the payment. If you had a private mortgage, they came due for renewal and you were hoping for some things to happen, maybe your income to go up, maybe your credit to improve, but you're hoping to get out of the private realm. How do you get out of the private realm when the value you were relying on from last year is not even there? Like, how are you supposed to refinance 80% loan to value from a year ago in the current environment?
So what are people doing?
Various things. If the renewal with the private is due and you have to make payment that you can't afford, you have to list and sell. And if you have to list and sell, what are you gonna sell it for if you are in that situation, right? You can't make the payments. So you delaying the sale costs you so much in penalties that it's almost not worth it to wait. So you end up listing and selling for what you can get. In cases where people are getting stubborn and they're not able to make sense of the situation in the market and their sort of peculiarity of their problem, the strategy to act as an ostrich and bury your head in the sand doesn't really work, because what happens is all these private lenders are so sensitive to customers and borrowers that go silent because they realize how long it takes to evict, right? That they are not wasting a minute. So the second you see somebody who has a private mortgage who is not communicating and not proposing a solution and not able to make payments, they are starting like default proceedings immediately for any reason they can, because they realize that the longer they wait, the longer it's going to take to serve, the longer it's going to take to get rid of possession, the longer it's going to take to evict, and then ultimately sell. So they're trying to shorten that distance because they feel the risk of taking too long. Because if you have a property that's appraising lower now, because this is where the trajectory of the market is, well, if you wait another 2-3 months, and then now we're like in the month of October, or maybe we're in the month of November, now the winter market is around the corner, and the winter market is not fun. Like, winter market is traditionally the worst time to sell. So they're realizing that if you're not able to bear the pain now, they have to get you moving fast, because if they don't, they're going to be stuck in a really bad cycle later in the year where things may look worse. And for that reason, nobody is wasting time.
I guess everybody keeps watching the Bank of Canada because that's basically
One navigator.
It's the only life raft. It's the only possible life raft that's going to be tossed out for everybody at this point. And not just homeowners, business owners, right? People who just can't keep up with the inflated prices of everything, food,
oh yeah,
housing costs, right? And what are they kind of saying? Well, not really too much. And I know that they're always kind of battling between the two of unemployment, right? If unemployment goes too high, well, then they got a problem. They have to start reducing interest rates to kind of spur economic activity, but then also fighting inflation. But the problem is both are going up simultaneously right now.
Yeah.
The next announcement is July 24th. Given all that, what do you think?
No change.
How
July
come?
24th, they'll just hold rates. They have no choice. They can't increase rates because they are afraid to do it. And I mean, for a good reason, because of what's happening now and what's going to happen after. They can't lower it, because if they lower it, then we might feel more inflation at following months. But it's not even that. They won't do anything because there's not enough pressure.
Explain. What do you mean by that?
So, when the Bank of Canada wasn't raising rates high enough, everybody was yelling, "Oh, well, you guys should do something about it," right? Like, everybody was doing it for a good 6 months. I think, like, I started being very vocal about we should be raising rates in December, January 2022. I was like, if we don't do this now, it's gonna get really bad. And then it did, and it did for many reasons that are outside of what I knew. Right, like some wars happened in the world and just threw everything completely out of whack and changed the way the world works, or has been working ever since. And I guess the way to think of the Bank of Canada in a modern context, especially in the context of summer 2024, is like in the Matrix, that had the Oracle, the old lady that told everybody that Neo was really the one. So we're all kind of acting as if Bank of Canada is the Oracle, and we're going to them and we're asking them for advice, and they keep giving you riddles. They're like, we may raise rates, we may not raise rates. Who even knows, right?
But they don't know. That's the thing.
They don't know.
At least in the Matrix,
but
the Oracle knows.
The Oracle actually doesn't know either. If you pay attention, she says that there's always the choice, right? Neo always has the choice of like breaking through the Matrix. And I guess the reason I brought this comparison is when you're looking at making decisions in this environment, you cannot take Bank of Canada as anything more than Oracle, right? You can just sort of pay attention to, listen to some of their anecdotal commentary, and then make up your own mind, because they are acting based on the pressure in the market. So the reason I said this a little bit earlier is when there was pressure to do something and they didn't, and then things went completely out of whack with the inflation and the interest rates skyrocketing, everyone said, well, we should have done this earlier. Why didn't you do this earlier? Could have avoided all this. And the Bank of Canada sort of took notice of that comment, right? And then now that there was so much pressure to lower the rates, and they weren't doing it for the longest time, they only did it once the pressure was so much that almost everybody in the media was saying you should lower rates, you should not wait any longer. And so they sort of folded under pressure. There's a couple of metrics that we're using to justify this, but really they haven't reached the desired equilibrium. So this rate cut in June was, majority of it was pressure, and a little bit of it was actually paying attention to metrics and then making an educated decision.
Isn't it that they're not supposed to capitulate to just
But they have to. That the reality of it is that in the modern context of politics and the way sort of the system works, if you're the kind of government who doesn't pay attention and then you're wrong for any reason or chance, you get crucified, right? But if you do whatever the public tells you to do and you fall under pressure and then it doesn't work out, well, it's like, well, you guys asked me to do this, so what do you want me to say? And so for that reason, right now that the June cut happened and everybody sort of was like, oh, okay, well, this is good, right? And everybody sort of eased into it a little bit and felt, okay, maybe this is a sign of things to come. And then they noticed that the inflation was rising, but they kind of sort of folded that, in the media to a degree. And so now the pressure is sort of off, but because the inflation is rising, we can't put any more pressure on it. It would be irrational to make them do something consecutively when things are, well, clearly showing the opposite, right? So it's like, okay, well, now the pressure is off for now, so the July announcement will just go for the most part unnoticed. And then as we sort of enter the month of August and September, we'll have a little bit more people putting more pressure on the Bank of Canada saying, hey, you got to lower again. Like, this was good, but we got to give it a little more. Let's refer to the metrics. Are they looking like they're stable? If they're stable, let's lower the rates a little bit. Let's give people a little more to work with.
I did a video, actually, you're kind of reminding me of it, a while back, where I was looking at a speech that Benjamin Tal gave, the chief economist for CIBC, and he was kind of talking about his experience with the Bank of Canada. I mean, he meets with them on a regular basis, and how they basically cherry pick their data to support whatever decision they're making at the time. And how when they looked at inflation, originally it was year over year. Then they said, well, that's not really what we need. We need month over month. We need quarter over quarter. We need it a monthly moving average, or we need it. Anyways, they ended up doing that for 6 different metrics, and then ended up at a 6x6, meaning that there's 36 different metrics that they can choose from. And if they want to be hawkish, they pick one number. If they don't, they just go and pick another number. And you're kind of reminding me of that right now. And so looking at all of this and saying, well, what's it gonna be, right? There is a bit of an issue there, because if they don't, right, typically this is what they do. They don't react, right, for way too long. And then when they do react, they overreact. Mm-hmm. Do you think that that's what we're going to see? We're going to see them just delay the reaction for far too long and then overreact when it comes time?
It will be depending on how the media reacts to the metrics that get posted. So if the media puts enough pressure on the Bank of Canada, then they will fall.
The media in Canada so far hasn't exactly been on a crusade to tarnish the Bank of Canada's reputation.
They can't. The government won't allow anybody to tarnish the Bank of Canada's reputation. Like, they'll allow some commentary, and that's a whole other perhaps issue. But we talked about politics a little while back on a different episode, and this all feeds into politics. So, like, something else just recently also happened that is part of this conversation, and this has been going on for about a year or two, I think now. So the regulator, the Office of the Superintendent of Financial Institutions, has been doing audits and having regular conversations with different financial institutions, because they're preparing something called the loan-to-income ratio. I hope I'm not butchering that term right now. But what's been happening is, we have certain different policies and programs that allow you to expand your portfolio and work off of different offsets. Like when you have rental properties, you can do certain offsets. And now there was a conversation that I was at a meeting with Manulife Bank. This was, I think, last year at the end of the year, and this is when this new change was coming into place. So essentially, what was happening is the regulator was suggesting that the banks, meaning the retail banks that we deal with, that we actually borrow money from for mortgage financing, should look at the income for the household and use that to limit how much debt they can take on, and anything outside of the regular box, they would have like an exception bucket where they can allow a certain amount of like not conforming lending, shall we say, right? Not something that fits the typical criteria, and that's supposed to be limited. So up until now, if let's say it's more certain things the banks can do, if the property that you're financing has like a relatively lower mortgage, a fair amount of equity, there are certain exceptions that banks can do, right? And that's helped people grow portfolios and do things over the years. So this change was coming in this year, and they just stopped it. They said they were going to delay it for another year. So why is that again? It's also it's technically different conversation from talking about the Bank of Canada right now and talking about the pain in the market and the interest rates and all that. But it's also related because it's another thing that was happening in the background that was supposed to restrict lending. And then it stopped because there was too much pressure, right, from different sources. And I don't know what drives the Office of the Superintendent of Financial Institutions. It's various different things, right? Various different conversations that perhaps in coordination with the rest of the government, made the decision that this wasn't a change to put into the market today. Maybe that's something we can do next year, but this year it's not good. Why is that? Because we have too many other pressures that we're dealing with, and this would just ruin what we are trying to equalize. And that's a political decision, right? Because, well, if you're just talking about the numbers and just doing the right thing and trying to tighten the system and make things work the right way, well, what's the difference? If you do it this year, the next year, wouldn't it be the same thing? But it would be this. It wouldn't be the same thing, because if you do it now, the current environment and the pressures that are on the on the regulator does not warrant the change, because the change would be too damaging. So the political decision, despite it being maybe the correct decision from the perspective of guidelines and policy and underwriting, etc., was to delay this. How interesting.
And nobody really knows about this.
No, it's just happening. Like I think I reposted the news article, and it just nobody paid attention. I think the views were there. Nobody even liked it because nobody understands what it's about.
Well, that's why I like having people like you on, right? Who can explain what these decisions are. There are a lot of different levers that they can pull, clearly.
I will say this. I'm sorry if I didn't. I may have butchered some of the definitions and the way that I described this change. If you're more curious about it, just go on Google and type in loan-to-income ratio and loan-to-income limitations, Canada, and just read a little bit more about it. And you will find quite a bit of information. Like it's all public knowledge, right? It's just that deciphering the lingo and what these articles and things actually mean is a little bit challenging.
So explain it in layman's terms so that anybody who's watching this video can understand.
All that it is instead of the banks having essentially not like an unlimited well of exceptions, but a certain leeway as to what they're allowed to do, they would be significantly more restricted with what they can do outside of the more traditional lending parameters. And that's a problem, right? If you're trying to be flexible in the current environment.
So for example, if I have an income of, let's call it a round number, $100,000 a year, you can lend at a certain ratio. Let's say it's a 4x above that.
4.5 times.
Okay, so 4.5 times that. Yeah. You can lend me $450,000. Yeah. And then in some cases there'll be an exception where you can lend me $500,000.
Oh yeah, if you have other properties, right? There's things like maybe some of the properties have lower loan to value, like a little bit less debt than the value of the property. Maybe like the ratios don't exactly fit the same way, and you have to do certain offsets. But with a couple of exceptions, you can maybe make it work anyways.
Right.
So right now you can do that. Coming this change, once this change is in place, the bank will be able to do it to a certain degree on a certain number of files, but no more than the allocated percentage of their portfolio.
So now they have to cherry pick who gets the exceptions.
Yes.
Now,
Not yet. Next year is when it's probably going to be in place, like officially in place.
do you think that those are going to be largely dependent, those exceptions that they pick are largely going to be dependent on, I guess, because banks also have to appease their shareholders, right? And they have a fiduciary obligation to make money for their shareholders.
Yeah.
That if there is a seriously low volume of mortgages that are sold at a given time, let's say in Q1, that they tell all their salespeople, hey, look, this is a time, use up your exceptions, get the mortgages sold. We need to show some good earnings for Q1. And then by Q2, it's all dried up.
It's all dried up.
Right, so that's a possibility because I think...
They won't do it like that. Like they will pace themselves because you want to... If you're a financial institution and you have, let's say, 15% of your entire portfolio for the year 2024 that you're allowed to make various exceptions on and step out of the traditional sort of guidelines, you're not going to do it for everybody. Like you're only doing it for the, cream of the crop. So if you're getting somebody who is...
whoever's close, or if there's like some kind of...
Well, that too. I mean, we're not going to get into that because I can't comment on that. But what I can comment on is that they will cherry pick the files that are the most wholesome, right? Somebody who almost doesn't need the money is the one where they're like, well, he's got like $5 million in the bank. What does it matter if I give him $500,000 more? That's where the exceptions are going to come in. Now, what this also technically supposed to do, it is supposed to level out the playing field for other smaller financial institutions who may want to make some exceptions and may want to do some things, but simply never even get the business through the door because the big banks take it all. Right, so the idea is that if you're a smaller lender and you have a certain bucket and a certain percentage of your portfolio that can be slightly, let's say, outside of the traditional guidelines, well, that's now pushing all that volume away from the big bank, which already used all its exception bucket, and now it's moving it towards you and it's saying, hey, you take the risk. Now do a little bit here too.
I guess you're kind of pointing out that those decisions are not always, from a logical standpoint, they could be political decisions.
Very much so, yeah.
But nobody's looking, nobody's watching, no one's listening. Why on the private side of lending do we start seeing private debt being so carefully monitored and rolled back in terms of their ability to do any kind of private debt lending, when really, if you were to look, zoom out, the public debt is what's way out of control at a degree that's far outstripping any of the private debt. Yet if we try to have a conversation about that, it's political suicide. Right? It doesn't really seem to make a ton of sense to me in that regard. What would you say about that?
Well, that problem has been postponed and delayed for ages, and I don't even know what it needs to happen for everybody to start maybe paying attention to it. Like Equifax released some data a little bit earlier about how we just exceeded 1 billion in retail debt. That was over 90. Was it retail debt or mortgage? I can't remember right now. It was they put a figure up of $1 billion that was 90 days past due. $1 billion 9 days past due, and my brain is not remembering right now, but I think it was retail debt. And if you think about it, that's pretty crazy. Like $1 billion worth of retail debt 90 days past due. That's like astronomically high. And I'm not talking about just debt. I'm talking about debt that's been 90 days past due, which means that in another 30 to 45 days, is going to collections. All right, and is going to be collected on. That's a wild number. And if there is anything I know from the sort of the years of dealing with credit and credit reestablishing and insolvencies, because that is one of the businesses I ran for about 8 years of my career. Like when that kind of debt is consolidated into a proposal, like a consumer proposal or a bankruptcy. Not to say that this is applicable to everybody, like every circumstance is quite different. But in most cases, when somebody goes for an insolvency order, right, like a bankruptcy or proposal order, the creditors don't get 100% of what's owed. Like,
no, of course not.
The average is 30. You get 30 cents on a dollar for the money that's being owed, because that's just generally how it ends up sort of calculating out, with some exceptions, obviously. But if you think about it, like $1 billion in debt right now that is 9 days past due, is going to collections in the next 45 days. even if half of those people and they declared insolvency by September 1st, what a wild number in losses to the creditors. Wild, like a number we've never seen before. Now, whether or not these people will actually go and file insolvency, we don't know. But many of them will, because the insolvency number is skyrocketing. And if you just go on the Government of Canada website and just type in insolvency, number of insolvencies in Canada, and you just sort of look at some of the charts, it's staggering how like crazy the curve is. Like we have so many business insolvencies, it's just wild out there. And it makes sense why, because the businesses that were marginally there maintaining themselves month to month can't do it anymore because the rates are so high. And something else also happening that's also worsening the situation, right? Like you have you have high interest rates, you have increasing cost of business that's also suffocating these businesses. So yeah, the insolvencies are rising, and that's evidence that number one, we can't maintain this cost of borrowing for long, because if we already seen the first wave, third wave of insolvencies, and they're just climbing, like how much worse is it gonna get? You know, if we don't see some improvements. And this is where the pressure comes in. The pressure is, well, right now the pressure is rising because insolvencies are rising. And now at some point in the next few months, there's going to be a public outcry about how businesses are suffering and everybody is closing down shop, and how people are losing jobs, and the only jobs being created are government positions that are being created through the government branch.
And isn't that where you start to see the government creep, right? Isn't that where we see the bloat in government start to really, really creep in? Because ultimately, at the end of the day, when especially a very liberal country like Canada, the government sees that unemployment's going up, businesses are going under, everyone's kind of turning belly up, they go, well, what's the solution to this high interest rate environment caused by high inflation? Is we need more government support.
Yes.
AKA more government money printing, which caused this whole thing to begin with, and is only going to make the whole situation way worse in the future. And no, we're not even talking about a future that's like, you know, far down the road. We're going to feel it.
You know how you do it? You call it not government support. You call it some sort of a emergency loan again. So they're not just going to go out there and say, oh, we're just going to pay everybody $50,000 and erase your debt. But they'll come out with some sort of a CERB program again, saying, oh, well, we know you're struggling, but we can't lower rates right now because we're still not where we want to be. But hey, here is a $50,000 loan you can apply for today. There's going to be no interest rate for the next 24 months. And then after that, your interest will be whatever interest rate. That's what they're going to probably do, because they can't do anything else.
They're just going to give out free money.
Essentially, just interest-free money, but you got to pay it back at some point. It's still going to be laid back on people who will be borrowing it. Like if you took out a CERB, which is the $60,000 you could get gotten from the government after the COVID situation happened, $20,000 was forgiven, which is what we will all be paying back into the coffers for the next God knows how long to the government. But the 40 was still needed to be paid back. The mistake the government made when they approved that program is the program did not require personal guarantees. So if you were a business and you borrowed that $60,000 and that business is no longer solvent, your $40,000 was never personally guaranteed. It stays with the business. The business goes bankrupt, the debt dies with it, right? So that money is not going back into the government coffers. If they learned anything from that experience, is that the next round of support they're going to give to businesses when they feel that they have to will just have to be better guaranteed by personal guarantee, so that people don't walk away from businesses they just borrowed against. So, but like to the public, it will feel like a relief for a little bit, because they'll get some cash in the bank. But like really just digging a deeper pit for yourself, because you got to pay that money back eventually. How you do it, I don't know. I mean, like if you're borrowing the $60K just to work out your cash flow, you know, unless you're thinking of other ways of making money, I don't see how your business is supposed to be viable after the interest rate free period ends, which is what happened with a lot of businesses who took out CERB, didn't have a viable cash flow operation, and when the interest rate kicked in, a lot of these businesses just had no way of surviving, and they just went out.
And I guess this is where we get a lot of the big problems with a lot of our population that maybe just reacts emotionally in the sense of advocating for change that maybe doesn't actually make logical sense or economic sense, let's say, and they go, well, we need help now, and then the government comes out with some kind of platitude that
Money for everybody.
right, or but they call it support for Canadians,
Yeah.
right, and this is caused a lot of problems for us and continues to cause a lot of problems for us because there is no such thing as a free lunch. No. And Canadians haven't learned that yet, which is shocking to me. It's shocking to me that Canadians haven't learned yet that there is no such thing as a free lunch, that we pay for everything. We pay for it through inflation. We pay through it through higher taxes. We pay through higher interest rates. We pay for it. The piper gets paid no matter what. And we haven't learned that yet. And so I guess the next logical step for this is, how do people protect themselves against that? Because it's most definitely going to come, and we are not going to just, stumble and magically fall out of this economic situation into a feather bed. It's not going to happen like that.
Well, I'm going to say something right now just to conclude on the topic of pain. So the consumer proposal order or the bankruptcy order, as scary as they are and as painful as they may appear, are actually viable ways of surviving this period, this drought, this situation that we're in, right? Because like right now, if you are paying a really high interest rate mortgage, or maybe your renewal is coming due right now, right? And you're hoping to consolidate some of your debt because you accrued so much over the last 2-3 years because your payments went up, right? Like maybe your other payments went up, your other credit card debt, your line of credit debt went up. And you are no longer in a position to refinance because also the value of your home went down, right? Like everything is just crushing down on you. So you should seriously look into, consider, and talk to someone experienced and knowledgeable about the insolvency orders. Because if you have a mortgage that you got 3, 4, 5 years ago is coming due for renewal, and you have all this debt that you've accrued since, and you have a limited amount of income and no equity in the property, the insolvency order can actually keep your home. Okay, you don't have to move out anywhere, you don't have to go anywhere. You keep your home, and they can consolidate and perhaps resolve a very large portion of your debt, same as I mentioned earlier, maybe 30, maybe 40, 50 cents on the dollar, whatever may apply to you. Every situation is very different. But I highly recommend anybody who is struggling with just the overall debt load to seriously consider those two orders. Despite them sounding scary, they're not as scary as they are. And if you understand how they work, it's really just a stop. It's not the end sort of your financial endeavors. It's a quick stop that allows you to recover, because the consumer proposal order is designed to specifically stop all interest that is unsecured. So if you have $100,000, $200,000 worth of 20%, freaking 25% interest rate on your credit cards and stuff like that, and you can't you can't refinance it right now because there's just not enough value, you should seriously talk to someone about maybe a consumer proposal or a bankruptcy, because those orders keep you in your home, allow you to consolidate your debt and reduce the monthly cost. Because if all interest is erased and on $100,000, even if it's like, I don't know, call it 12%, right? It's 1% a month. $100,000, 12%, 1% a month is $1,000. If it's 24% because your credit card debt is at double the interest rate, it's $2,000 on $100,000 worth of debt. Like if you don't have to pay that interest and you could actually put that money towards the balance, wouldn't that be nice, right? And so these orders are definitely very valuable in the current circumstance. And I'm not suggesting they're for everybody, but they're definitely worth looking into if you're really in a lot of trouble and you're really struggling.
What are the consequences of doing that?
The consequence is that your credit is essentially frozen for the duration of the order. So if your order is 12 months, 24 months, as long as 5 years, this is the longest period you can get for a proposal, you cannot borrow. So during that time, your borrowing freezes. You got to pay back whatever you agree on. Let's say you owe 100,000, you'll pay back 30, whatever that payment comes out to per month divided by 60 months. And then at the end of that process, you get discharged. So the debt is gone. You don't owe anybody anything.
What about your credit score?
Your credit score is, for the most part, non-existent because you haven't been credit active. But
So it doesn't ding you in any way?
The credit is ruined because it's essentially like everything is insolvent, everything is delinquent.
Right, so your credit score is destroyed.
For the most part. There's no point of even talking about the specifics of the score itself because it's irrelevant. The moment you file for insolvency, your credit freezes essentially. And it only unfreezes when you get discharged. So if you finish the order and then you come to somebody like myself or some other broker and you start working on your credit score, that's just a matter of getting a couple of new accounts and essentially doing the same thing you did when you first got your first credit card. You got to just build it back up. That's all that it is. It takes a few years, couple of years. Like CMHC, the governing body for mortgage insurance in Canada, actually has guidelines. So even if you went through bankruptcy and you wanted to buy a home with minimum down payment, you can do it. 10% down, like not 5 maybe, but 10, they'll support you. And show that you've been making payments for 2 years, a couple of different accounts, no delinquencies, you're good. And like I like those files because I understand the insolvency orders, they don't scare me. If you've been insolvent in the past and you just got discharged and you have no debt, that's fantastic. The number of people who apply for mortgage financing who have a boatload of debt is incredibly high. So if you have an applicant who has none, that's like a blessing. Right? So the question just becomes, do you have enough down payment? Do you make enough money in terms of your income? And do you have your minimum down payment? Because there's no debt. It's so simple. So like, I love those applications. It's just that they do take a little bit of time. And for somebody who is already in a home, what does it even matter? You're not looking to buy anything. You're just trying to minimize the pain. Minimize your pain, get through it, finish it, rebuild your credit, and just like deal with it like everybody else.
You're just right now preaching the Canadian version of Gary V, kind of talking about living within your means,
Sure.
doing the smart, financially responsible thing, and just kind of pushing through it, David Goggins style, for the next few years. And that's fantastic, and I love that message. However, what I will say about that message is in the era of social media and immediate gratification only, please, thank you very much. I don't see a lot of people doing that. Not only that, but we also, we live in a fiat currency system where everything is a debt-based monetary, financially, kind of screwed up system. And without the ability to be able to borrow, you are kind of handcuffed. And I don't want to say that like borrowing money or debt is the solution to everything. It's simply just, unfortunately, the system that we're in. And I actually think that, I think it was Charlie Munger put it really, really well, where he said, if you're good with money, then, he said, if you're not good with money, then you shouldn't use debt. And he said, if you're good with money, you shouldn't need to use debt. And I really like the way he said that. And I always kind of think about that. Charlie Munger's amazing.
It's a very perfectionist statement because it essentially leaves you in nowhere but a limbo. Because, if you argue with money, you should be leveraging it to a degree. You shouldn't be over leveraging yourself.
He said you shouldn't need to use it.
Shouldn't need to use, but you can.
But you can.
Okay, true. That's fair.
And I think that in the debt-based monetary system that we're in, right, which obviously doesn't make sense. We know modern monetary theory does not make sense.
Well, the problem is that we don't live in a culture where budgeting is a thing. Like, I come from Russia. I come from a country where credit, for the most part, for as long as I lived in that country, just didn't really exist. Like, your credit was your parents, maybe. That's about it. So if you didn't have the money, you didn't spend it, right? So you budgeted really well. Your budget balanced every month because you couldn't just go and borrow $500 on a credit card to cover the payments. You cannot, because you just didn't make enough. And somehow I remember growing up, and my parents didn't make a lot of money, but everything always budgeted. And there was like a Christmas tree at the Christmas time, and there was some presents by end of the Christmas. Like, things worked without credit at all. So the Western world is very relaxed about it. Like, we've learned that credit is a convenience. It's your best friend. It gets you things you can't buy otherwise. And that's all fantastic. But I just had an interesting conversation yesterday with one of my customers, and she's a very nice lady, God bless her. And she's not been very well for the past little while. And when I was just trying to figure out her budget because I'm trying to figure out what she can afford. And the question came up like, what is your actual budget? And her answer was, I don't have a clue. And we laughed about it because we both thought it was kind of funny.
You know what the really funny thing is?
What?
You could ask the same question to Justin Trudeau and get the same answer.
You're probably right. We don't live in a culture where budgets are done. Like nobody does it. Nobody actually physically sits down and figures out their expenses. And if only you did, it would be so easy to figure out what you can or cannot do with your money. Like it would be very easy to figure out whether you should even have a car. Maybe the car is not an affordable thing for your household. Maybe you shouldn't have one. But we don't. Like we just go and we go, oh, well, I have money in the bank. I have money coming in. And so, I'll be fine. So the retail channel just gets all kinds of credit given out because people are not thinking that choice, the decision through long term because they're not working on a budget. They're working on an imaginary well of money that never ends. And it's sad, but it's the truth.
So what do you think people who are actually looking to take advantage of this market should be looking for? Because I am starting to see, believe it or not, it's, to be honest, even a bit of a shock to me. I am starting to see upsizers kind of come out of the woodwork right now. And they're saying, hey, look, prices are depressed. Why would I not take advantage of this, right?
Yeah.
I've been financially responsible for X number of years and have lived within my means and everything.
Absolutely.
Or, hey, the business is doing well. And, despite this clearly per capita GDP recession that we're in, we're doing okay.
Yeah.
We've made those right choices years ago so that we can make better choices now, or at least take advantage of the situation, which, Canadians are always talking about cheaper housing and why they can't ever get those opportunities. And there is kind of an opportunity now for that. So what would you advise those people, because they are looking to reap that reward right now?
It is pretty straightforward, actually. So the two main asset classes that are they're just so hard to finance, and this is going to be the main reason why they are not selling very well. The two asset classes in real estate right now that are so hard to finance is condos below 500 square feet.
Yeah.
And homes over, I'd say like 1.5 over 2 million. It's just the amount of income it takes to qualify or to be able to buy those properties isn't normal. Like, not normal for majority of the households. And let's just break it down. So if you're buying a property worth $2 million in July 2024, first of all, you need down payment of 20%. You just can't buy this for less than 20. Just if you have less than 20%, not for you. 20% of $2 million is $400,000 plus land transfer tax, which is like what, 50?
If you're buying in the city of Toronto, it's going to be somewhere close to $80,000.
Dude, just land transfer tax is so painful that you
actually, sorry, a little less than that. Let's call it 70.
Let's just say you need 500,000 to buy this damn thing.
Yeah, for sure.
Like you need the land transfer tax. You got all kinds of
fees,
things and fees and legals,
lawyer,
yeah, everything. So let's say that's what the requirement is. So first of all, who the hell has $500,000?
Well, I'll tell you, they have equity in their property that they're trying to sell.
Not those people. Those people are already in the market. I'm talking about the people entering the market. The ones that are in the market, they can do stuff.
First-time buyers aren't buying a $2 million property.
Thank you very much. So if we're only talking about people that are buying those properties, not being first-time buyers, but being existing homeowners.
Yes.
So they need to, if they buy this thing, they have to sell their thing.
Yes.
Right? And if they buy this thing, so let's say they have $500,000, they have the 20% down payment, $1.6 million worth of a mortgage in terms of like what you need in terms of income, that's an income of like $300,000 to $350,000. That's a lot, right? Like, not to say that people don't make $300,000, $400,000. It's fine. We see them all the time, just not very often.
Right.
Like it's 1 in 20 applications, 1 in 25 applications is the guy that makes $400,000 a year. It's not normal.
Or it's stashed in a corporation.
Sure, and like those types of applicants, they will make the moves and they will make the things. They'll do the types of upgrades you're talking about. But then they are leaving this inventory behind, and often they're moving from, let's say, a $2 million home to a $3 million home because their family is growing, their income is growing, and they can afford it. Who is buying the $2 million property? Because that property has to be bought by somebody who is hopefully moving out of a condo, at least has enough down payment to buy this thing worth $2 million, because you need to have $400,000 to $500,000. Like, there's just these gaps.
And it's a domino effect.
Right, where it's like, okay, well, this guy moves here, but then what do you do with that? And,
Right.
it doesn't really make a lot of sense because the next person to hold that bag is not there.
Right. So the condo market, which is what is fueled by first-time buyers, and first-time buyers are non-existent right now.
They're very picky. They're there, but they're like, oh, I don't know. It just.
Well, what can they afford, right?
Sure.
They're looking at what they can afford. It's a shoebox.
Yeah.
I don't blame them. I felt the same way when I was looking to buy when I was a first-time buyer, right? So the condo market is essentially what is the backbone of every upsizer out here.
Yeah.
And that market is held up by first-time buyers.
Yeah.
First-time buyers are non-existent.
Yeah.
This whole market becomes a frozen tundra, wasteland.
Just ridiculous amount of inventory and no one to buy it.
Right. So what would you recommend for somebody who is looking to make that upsize I mean, I know what I always say is, I always say sell first, go into it with anchored expectations. You know, we've gotten so spoiled in this place and used to a house sitting on the market for a week or 10 days and selling, and a low marketing tool of a price going out and selling way over asking, and everyone's jumping for joy. And the overall message, if I'm understanding you correctly, because I'm kind of spouting the same message, is, guys, the party is over.
Yeah, you could say that. There is definitely not enough activity in the condo market at all in general, but especially the everything that's below 500,000 in terms of its current price tag, right? Just whatever the listing is what used to be 6 just a few months ago. Whatever is listed at 399 is what used to be 5 or 499 just 3 months ago. That is because it's getting oversaturated with listings, and the buyers that are looking at these shoebox condos saying, well, I don't know if I want to do this. Like, I'm pretty much putting everything I got into it, and I can raise a dog in this living room, but I can't raise a child.
And not a big dog.
Not a big dog.
We're talking like a Chihuahua, maybe.
If you buy a big dog enough, it'll eventually eat you because it will have nowhere to go.
It's in a cage.
So that segment of the market, oh man, how many there are! Oh my God, and how many there are already on the market, and how many aren't yet on the market because there's still a tenant, and when that tenant leaves, like.
Well, it's investors that are getting crushed right now. I'm seeing right now downtown Toronto, and I think we talked about this on the last podcast, is there are tons of condo listings right now. Just like, you look at the map, and it's like the map has chicken pox. It's just red.
It's crazy.
Red little dots everywhere. They're all listings. And when you look into those listings on my end, I can see if they're owner occupied or not. 70 to 75% of them are either vacant or tenant occupied, meaning those are investors.
Yeah.
And those investors are desperately trying to get out because those payments are eating them for breakfast, and it's really a bit scary. I'm also seeing a lot of power of sale as well on those investors, right? And investors are just simply, they're saying, well, all right, take it.
Pretty much, like, that's exactly what it is. I had just had a deal where it was like that. The person lived 4 hours away from the house, was not even maintaining it properly, not humidifying the basement, not fixing problems here and there where they were showing up. There's some painting to do. And when it came down to sort of negotiating the offer, the buyer ended up kept asking for more things the entire time. And they kept giving them to him because they're like, I just, almost anything you want, just take the frickin' place and just get it off my books. right? So like even asking for like leaving things in the house, just like they were used for staging. It's like, can I have that? It's like, okay, just have it, just get off my case, right? Things that you used to never see for many years is what you're seeing now. And this is kind of what's happening already, right? So this is that segment of micro condos, also homes that are just not in the most desirable areas. That's always a problem in this market.
Or they're beat up.
Or they're really beat up, yeah. Like if you're in an area that is not great, why would anybody buy your property? You can just literally go across the street and look at the different one that's a little bit nicer. And the price differential is so minor. There's no bidding wars. So if you are listing those homes, you're listing super low because you're just trying to get foot traffic and no one is coming.
It's so funny because when you say there are no bidding wars, I still see agents out there trying. And I had a listing appointment last night where I'm sitting with this couple looking to make a move. People who have been financially responsible their whole lives, and they're in a great position. They want to make a move. They want their family to be in a different position, right, with a different living situation. Great. And I remember we went out to do some showings over the weekend, and when we were sitting there last night in their house, and they kind of said to me, when we go out to see these properties and they're listed at $999, that's the real price, right? And I said, yes, now it is. And they said something so interesting to me. They said, good, because we really feel like the people who don't do that with the right intention and list it low, trying for a bidding war at this point in time in the game, that it's an insult to our intelligence. Because we're not just buyers, we're also sellers, and we won't do that, you know? And I found that so interesting because I said, you know what, you're absolutely right. There is tons of buyer fatigue, and why even bother? What, on the off chance that you might get a bidding war? I mean, give me a break. Who really wants to compete right now in this market as if there aren't other options to go for? Yeah. You know, as if time isn't your friend if you're buying. You know, really at the end of the day, I think the more transparency we're able to provide to buyers, the better, right? Regardless of what someone may anecdotally think might work now because it worked in a hotter market, this isn't a hotter market. And I found it amazing that I had these people who want to sell telling me, we're not going to do that to buyers. That's not right. When, you know, a few years ago it would have been whatever you think is going to get us the most money, Adam, right? Coming back from that and going, well, these sellers are now starting to really care about buyers' feelings now in it. I found to be fascinating. And I remember also having on Vivian Reese. She's my broker of record. She's a fantastic, just a fantastic mind. And she was telling me all about, when I had her on, how she was coming up in real estate in the late 80s and early 90s, how the market tanked in 91, and how she was just crushing it because she had no idea the market had even tanked. She was just saying, I remember it like it was yesterday. She was sitting right there in the chair you're sitting in now, and she was saying to me, you know, you can't have a mindset that the world is collapsing around you. There is opportunity everywhere. And if you're not of the mindset that there is opportunity everywhere, then you're not going to go looking for it. And if you don't go looking for it, you will never find it.
True.
And she was very, very stern on that message, which was, it doesn't matter what's happening. Put your blinders on. Ignore what the headlines are. Ignore what the media is saying. Yeah. Go out there and try to make it happen. Be financially responsible. Get your ducks in a row. But take advantage of opportunity when it arises. Now seems like a great time for buying real estate in a market that was otherwise impossible to buy in.
Yeah.
And I see people like you who are working with real consumers, pushing numbers around on a spreadsheet, making it work so that underwriters will go, here's a thumbs up, you're good to go. What should people be doing?
Should be doing? Well, I mean, opportunity, as you said, comes in different shapes and forms. A lot of the time, like when these types of situations happen, with the market taking a bit of a turn, uh, the opportunity is not really obvious, but it's there. So, for example, if you're a retiree and you were thinking of downsizing and you are making an argument that it's not the good time to downsize, I'd actually argue the opposite. Like it probably is a good time to downsize because, yeah, you will lose some value on the sale of your home, but you will gain some value on the purchase of your next one, right? So you can make sense of it in that sense. Will you lose some money because you're not selling it for whatever millions of dollars you thought your property was worth? I mean, it's irrelevant type of it's subject to like interpretation, I guess, because for somebody, that property that they bought at a declining market at a discount because nobody else was available was the property of their dream. How is that a bad choice, right? If you really got something you really really liked, maybe that property in the right market would have cost you $100,000 premium. So it's just like making sense of what's in front of you. If you're a family who is looking to upsize in this market and you have a fair amount of equity, you have been financially responsible, why not? I have people right now who I am literally pre-approving for gigantic lines of credit just because they want to see what happens next and maybe pick up a property or two. These are people who are very smart. They're very well educated, very wealthy. Some of them have zero debt, literally, in the current economy, which is very impressive. And they're coming to me in this time. Just think about this for a second. I have these people coming to me in one of the highest periods in terms of interest rates that we've seen in God knows how long, and they're asking for money. Right? If that doesn't tell you something, I don't know what else can. That the people who are smart and are willing to sort of take a bit of a risk, but are very, very careful, are lining up their cash to do whatever. Buy something, convert it, maybe renovate it, maybe flip it, maybe subdivide, maybe like you name it, right? But those people are doing what you're talking about. They're not burying their head in the sand and saying, oh, this is just bad time. They're saying, 1 minute, what's actually bad about this? And then they realize that it's really just the cost of borrowing. And they go, wait, 1 minute, but the cost of borrowing being bad means there is opportunity at the end of this transaction. And they go, well, I would like to take advantage of that. Right? So they come to me and they go, hey, I want $1 million in a line of credit. Thank you very much. I go, okay, let's do it. And then the beautiful part is people don't know this, but if you borrow a line of credit for $1 million, $1.5 million, whatever that is, and then you go out and you buy that property, that cottage you always wanted, just could never possibly afford because Muskoka was triple the price it is today. Triple the price that it was when you first started thinking about it, and then the market now took a turn and now it's finally affordable and you can actually go and buy it. Well, you go and buy it for that line of credit, you literally write a check on it, and then you go back to the bank and you just convert it into a fixed term mortgage, and then you get like your 5% or whatever that you can get right now when you convert it. Like, what a phenomenal way of doing it. You're loading yourself up with this gigantic line of credit, so you have the cash. You're not buying anything yet, but you're ready. And then when you start looking, with the second you find something you really, really like, you've always wanted, you just write a check. No qualifying, no conditions, just here you go. And you can put whatever number you want in it, right? And the seller will probably is more likely to take it than not, maybe negotiate a little bit, but you have the power. What an incredible position to be in. How opportunistic, but how smart.
Well, I think that that's the positive note that I'd love to end on. And I appreciate you coming in and always kind of giving your perspective on what's going on, both in the macro sense and the micro sense of exactly who's doing what.
Yeah.
And I am seeing that on my end too. I am seeing people who have really been working hard for a long time, keeping their head down and grinding away, now taking that opportunity because it is presenting itself right now.
Yeah.
For those who have been responsible, for those who didn't go really nuts during COVID with all of the free money kind of just floating around.
It is what it is. Yeah.
But thank you so much for coming in, and I always really enjoy talking with you. we got to do it again soon. And actually, I would love to do it again after the next interest rate announcement, because I think it's going to be a live one as well, so that we can actually hear what the
Let's
messaging
go.
is from Tiff McClem.
Sounds great.
Cool, man. Thanks so
Appreciate
much.
it. Thank you.